Hi folks, my name is Nick Langley, Portfolio Manager on the ClearBridge Infrastructure Strategies. I want to talk about performance year-to-date 2025 and our outlook for 2026. But let me start with some of the themes that are in our portfolios today. The key ones are energy transition. So think about renewables, think about the poles and wires being built out to connect the renewables to the grid, the EV charging stations that are going in and so on. That's all regulated expenditure, and we're earning great regulated returns for our companies. Then we have the impact of climate change. It's the mitigation of climate change impacts on networks, and it's also the adaptation of our networks to the effects of climate change. This is driving a significant amount of what we call resiliency spend being signed off by regulators, implemented by the companies. It's things like moving electricity transformers from the ground floor up onto the first floor in zones that might have storm surges and flooding from hurricanes and the like. Then the third category is really electricity demand. Obviously, one of the key drivers here is data centers and the AI demand that's coming through, but we're also seeing significant upticks in demand from the industrial customer base of our companies. So think about those three strategies, and then let's take a look at the performance year to date. We've seen very strong performance out of our European exposures in our strategies. And what's interesting about that is when you look at the benchmarks, the indices that are out there, like the FTSE 50/50 index, which we bench against, that European exposure is only 10.5% of that index, whereas we carry a much higher exposure in our portfolio. So that's a hit out for benchmark unaware portfolio construction. So ultimately, our decision in the first quarter of this year to allocate more capital into Europe has done great things for the portfolio performance over the course of the year. On the sector performance side, it's really been driven by the utilities, and within that, it's the electric space. So the electric companies are at the center of those three major themes that I talked about: the energy transition, the climate change, and the power demands coming through. That's driving increased capital expenditure. It's driving growth in the underlying asset bases, which is flowing through to growing earnings, growing cash flows, and growing dividends. Let me talk a little about the macro drivers for 2025 and what we see going into 2026. Indulge me with a couple of charts for a moment. This first chart here shows on the grey line the 10-year break-even inflation in the US. And whilst we talk a lot about inflation, really it's been pretty flat over the last 3 years. The green line is the 10-year Treasury yield. That's important because that goes into the valuation metrics that ourselves and plenty of others in the space use to value our underlying companies. And we can see that obviously that bond yield, that 10-year Treasury yield has gone a lot higher over the course of the last few years. And that's really driven real yields higher over that time frame. Now, the blue line that's on the chart is the Bloomberg consensus for where economists, investment banks, and others think that 10-year Treasury yield will be in about 2 years' time. And so think of that as the forecast yield going forward. So if we put together that forecast yield and that break-even inflation, then we get a sense of where the market thinks real yields are going over time. And that's important because our valuations tend to be linked to those real yields. And so you can see from this chart the connection between expected real yields and PE multiples of the utility index inside of the S&P 500. Pre-COVID, they were connected. They blew out during that COVID period, which was really a market risk premium issue. Then they reconnected, and then in the second quarter of 2024, we started to see them diverge again. It's really obvious when you break it down and just look at the regulated companies, which form the core of our investment universe. You can see again here the break in second quarter of 2024. So really, what's been going on here? Well, if you'd listened to me at the end of last year or beginning of this year, I would have said we don't need bond yields to come down this year. What we need is for bond volatility to reduce, and that's the MOVE, tracked by the MOVE index in the US. And so you can see, the MOVE index has steadily come down this year, and it's matched the PE. The PE's actually increasing. Note it's inverted in that chart, so the PE's increasing over the course of this year. The other thing that's driven that, importantly, is the increase in growth expectations. This is earnings growth, EPS growth, consensus estimates, again, of those same 50-odd companies that form the regulated companies that we follow in the US. So you've seen that increase from about 4.5% back in 2024 up to close to 7% per annum expected growth over the next 5 years. Right, and so that's been a significant increase in the expectations for earnings growth, and that flows through into better multiples for those companies, better valuations. So listen, where do we go from here? Right, because when you look at those regulated companies, you can see that they're really pricing real yields in the order of 0.5%. Right, and if you're thinking inflation, long term is going to be a little over 2, then you're talking about bond yields, nominal bond yields in the order of kind of mid to high 2 range. So in 2026, we need to see those bond yields start to come down. Otherwise, we think it'll start to pressure some of the valuations that are attaching to these utilities across not only the US, but across the world. And so as we think about our outlook for 2026 from a macroeconomic perspective, we are expecting those bond yields to come down. The governments are pushing a lot of liquidity into the markets on a fiscal basis, into markets and economies, and central banks are turning a bit more dovish, rate cuts in the US and the like. We do expect that that will lead also to an uptick in economic growth through 2026. And our expectations are actually above market as we sit today. And what is happening is that is causing us to start to rotate our portfolios. The investment signals that we're seeing coming through our process are saying you should be buying more GDP-sensitive infrastructure names. Think about anything involved in moving people or goods around the economy, the roads, the rail, the ports, the airports, and the like. Also, energy infrastructure we count in that category. And so what we're doing in our portfolio now is we're starting to buy some more rail, we're starting to buy some more airports, we're starting to buy some more of that energy infrastructure exposure for the portfolio, expecting that the areas of growth for these companies are going to shift a little from the utilities, which have had great earnings growth over the last couple of years, into the more GDP-sensitive infrastructure names. And we think that will allow the portfolio to generate good returns through 2026.